All right, we're back. Bob Pisani has today's ETF Edge. Bob, we're talking about active management today.
Yep, all-time record, Scott. The market volatility this year has corresponded with a rise in active ETFs. Last week, active ETF assets under management surpassed $1 trillion. That's the first time ever. It's now about 10% of ETF assets. Let's talk about that with Matt Bartolini. He's head of Spider America's research at State Street. They run the world's largest ETF. That's the Spider S&P 500. Matt, good to see you. 30% of the inflows into ETFs this year have been into active funds. This is another record. Is this rise in active stock ETFs in general correlated to the recent volatility in the markets, or is there something else going on?
I think it's a little bit of something else. I think it just speaks to the versatility and flexibility of the ETF structure and the type of strategies that can be provided now in this type of format, because it's really not a lot of just sort of deep-rooted fundamental active strategies. There's a lot of different types of approaches within the active ETF market, like ones that can manage volatility, like ones that can seek higher income opportunities, like ones that are more cash plus type vehicles. So I don't think it's a result of the market volatility. I think these are secular changes and trends that we've seen play out over the last few years, and they're now being accelerated this year as more investors are becoming comfortable in using active ETFs in their portfolios. Right.
So when I think of active management, and most of us do, I think of old-fashioned stock picking like Cathie Wood's ARK fund. But you're saying that's not entirely what's going on. There's other kinds of active management, people seeking protection against losses or people seeking income, for example. And that's considered active management, right?
Yeah, they're using an active construct, so filing under exemptive reliefs that give them the ability to be active for that flexibility. Or they're doing it because it maybe is a better way to approach a certain type of marketplace. So for instance, the #1 category that has had the highest amount of flows this year is the ultra-short bond category. That's a category that's trying to eke out more returns over cash, and you can actually find some real good inefficiencies by using securitized products and not just owning sort of your T-bills or whatnot. So the ability to use active in some markets is because of the flexibility. And then again, some of these constructs, they're really rules-based, and they're only being active in terms of when their trading strategies would kick in. So it's not that sort of similar historical, 30-stock portfolio active that a lot of people think about.
So this is a good point. Big inflows into active fixed income because investors are flocking to these ultra-short funds. Now, is this because the yields are in the 5% range? I mean, why is there suddenly a big interest in ultra-short active management?
Well, this is where there is a little bit of recency bias to the market volatility, like you mentioned on that first question. I think you're starting to see some folks go into that space just to sort of hide out during this period of pretty sizable market volatility within equities, where a lot of investors are also have a lot of concentration into. So I think part of it's that. Also, but to your point, your yields are looking pretty good at this point as well in that 5% range, and that active sort of flexibility can maybe get you a little bit more from that perspective.
Okay, much more coming up on how to play active ETFs. That's coming up 1:10 p.m. Eastern Time on ETF Edge. Todd Sohn, head of ETFs for Strategas. Nature Racy from the ETF store will lay out the active ETFs in the fixed income and equity space with the greatest inflows this year. We'll name all of them. That's coming up on etfedge.cnbc.com.